Economic news is mixed. We're going into a recession. Are we back in bullish territory at this point? Whether or not we're headed towards a recession will depend on who you ask. Regardless of what happens, in this video I want to talk about how options traders like us can navigate through a potential recession. First off, we need to know what a recession is. A recession is a period of economic downturn characterized by a decline in GDP, gross domestic product, high unemployment, and a decrease in consumer spending. As options traders, it's important to understand how these factors can affect the market and the potential opportunities and the risks that they present. Let's go over a few opportunities that option traders can take advantage of during a recession. Number one, a strategy that options traders can use during a recession is selling options. So what's happening there? When you sell an option, you're selling something that you don't own. Your first transaction is not to buy the stock or to buy an option, but to sell a position that you don't own. It puts you in what's called an uncovered position, but it gives you a much higher probability of being right in that transaction. So if you sell a naked put, that means you believe the stock is going up. By selling that naked put, someone's going to pay you. If the stock goes up a little bit, you'll make money. If it goes up a lot, you'll make money. If it goes sideways, you'll make money. If it goes down a little bit, you'll still make money. You only get in trouble if it goes down a lot. Now, in a bear market, option premiums are typically higher, which means that option sellers can potentially earn more income. However, it's important to remember that option selling comes with a different risk than buying just the underlying stock or the asset, right? And as the stock price can increase, which could cause a higher loss in the options position. Number two, another strategy that option traders can use during a recession is buying put options. Now, buying put options gives the holder or the buyer the right to sell the underlying asset at a certain price. Now, in a bear market, the price of the underlying asset is likely to decrease, which means that the put option will increase in value. This can be a way for options traders to profit from a downturn in the market. So in other words, if the stock is trading at $100 and I said that I'm going to sell to somebody the right to buy the stock from me at 100, and the stock drops down to 90 or 80 or 70, yes, the stock dropped in value, but I can now force somebody to buy that stock at $100 and not lose anywhere near what it could have cost me had I just had the outlying stock and not had bought the put first. Number three, it's also important for options traders to keep an eye on the volatility of the market during a recession. You can do this by watching the VIX. Now, the VIX monitors volatility. It's the fear factor, or the degree of variation in the price of an asset if you want the book definition. Volatility tends to increase during a recession. This can present opportunities for options traders to profit from volatility by collecting greater premium. But it also means that there's a higher risk potentially, and options can become more expensive. So what VIX is, it's an inverse relationship to the market. When the market goes up, the VIX goes down. Why? Well, when the market's going higher, fear is less, so the VIX goes down. When the market's going down, fear gets greater and fear increases. Let's compare the VIX to an insurance policy on a car, let's say. If you've not had any accidents, right, the market, the car has been doing well. So your premium on your car insurance can go down. But if you've had a couple of accidents, well, volatility is up now. There's a chance you can have a worse accident or another accident. So the premiums of your insurance policy go up. It's the same with options premiums. When there's more volatility, there's more fear, there's a greater increase in the cost of the options. A recession can present both opportunities and risks for options traders. Selling options and buying put options can be potential strategies, but it's important to keep in mind the potential risks and to keep an eye on market volatility. As always, it's important to do your own research and make informed decisions when trading. Until next time, make it a profitable day. Stay focused on the quest to becoming a great trader. Keep crushing it, and remember, you're just one trade away. Check out another one of our trainings right here.